And Andy, I want to get your views on the recent surge in bond yields, which has caused some volatility in equity markets, and obviously is in the press quite a lot at the moment.
Yeah. So let me just take a step back and look at what's actually happening. So we know that the global economy has just started to experience a meaningful cyclical economic rebound, and that will only continue throughout the course of this year and into next year as well as economies open up post-virus. We know that there's still plenty of stimulus about, both on the fiscal side and on the monetary side. And so that's created some degree of speculation that perhaps inflation will take hold, and that's resulted in an uptick in bond yields. And so the chart that I've just shown here while I'm talking is a chart of the US 10-year government bond yield going back to about 2016. And so you can see that 2016 to 2018 example, where yields went up from 1.5% to 3%. And then more recently, yields have gone up from about 0.5% up to 1.5% over the last 6 months or so. So that uptick in bond yields more recently has caused a bit of a stir in equity markets. We've seen some equity prices wobble a little bit. And the question, of course, is, is this the beginning of a real fly up in bond yields as a result of, inflation, which is taking hold, or not? We certainly remain in the camp that won't be the case. And as a result, we think that the market is really overreacting. Now, we could, of course, be wrong here, but let me tell you why we hold that view. And what I'll do is I'll break it up into a sort of a short-term view versus long-term view. I mean, short-term, it's almost as simple as, there's still 10 million Americans out there who are looking for work who can't find it. There's 44 million Americans out there today who are still on food stamps and really struggling to make ends meet. These are not typically the types of conditions that result in really aggressive wage inflation. This analysis is also, for what it's worth, is consistent with all the analysis we're seeing out of the major central banks. That the overwhelming consensus view is that this recovery still has a long way to go. So that's the short-term perspective. And then longer term, we really just take it back to, thinking about some of these big long-term structural drivers. And, we think about things like aging populations. We think about things like advances in automation. But really the big one is the degree to which governments are indebted, really as a result of funding all of these major fiscal stimulus packages. And that's really important. I mean, in our view, that's really going to place a lid on interest rates and stop them from increasing materially. And I'll just give you a simple thought experiment to illustrate this point. So today, as a result of the gigantic fiscal programs that the US has undertaken, their public debt, or their federal debt, is about $28 trillion US. Okay, so let's say the US 10-year yield increases from, it was 0.5% a few months ago. Let's say it were to go all the way up to 3%, right? So that's an extra 2.5% of sort of extra interest rate, which drives up, of course, in the fullness of time, drives up the borrowing costs for the federal government. Well, that's an extra $700 billion US that the federal government has to pay to service their debt that is otherwise not being used for fiscal spending. And so, all else being equal, either taxes would have to be raised or spending would have to be cut. Both of these things are disinflationary. I mean, that's more than a 3 percentage point sort of GDP negative fiscal stimulus each year for the rest of time. So that alone would be enough to push the US back into recession, and frankly, the whole world back into recession. So our argument long-term, irrespective of what happens in the short term, our argument is that long-term, we don't see a world, we really struggle to see a world in which interest rates can remain higher for a sustained period of time, given that feedback loop it would have on all of the indebted governments out there who would have to service debt at much higher costs. And then the final point I'd add is that, if we use Japan as an example, and Japan over its sort of course of its interest rates falling from 8% down to 0 over a period of 25 years, and I'm just showing the chart on the screen, there have been numerous instances over short periods of times where you've seen bond yields, tick up sharply, whether it's 50 basis points, whether it's 100 basis points. It's happened a lot, but you zoom back out and the long-term structural trend in Japan, for a lot of the reasons that we've described around aging populations and increased government indebtedness, is really kind of a low growth, low interest rate environment. And so that's where we think we're ultimately heading, notwithstanding the cyclical upturn that we're experiencing over the next 12 to 18 months and all the stimulus to go with it.
Yeah. Okay, so to summarize, interest rates aren't going to be a problem and will remain low, I guess, for a very long time.
So yeah, that's certainly our long-term view for sure. And so that's why we think it makes sense to own, some of the long-term winners, some of the long-term high-quality growers out there, like a Microsoft, like an Alphabet, like a Spotify, like a Tencent, for example.
Yeah, okay. But you do also own some names that are benefiting from this sort of short-term cyclical economic rebound. Is that right?
Yeah, that's right. So we do have some exposure in the portfolio as well. So names like Visa and MasterCard, so they still have a wonderful long-term growth story. Obviously, there's still a lot of cash and check transactions that can and will be shifted to cards over time. There's still $18 trillion of that transformation still to happen. So that's a great long-term growth story. But short-term, they're really going to benefit from the cyclical rebound, and particularly the opening up of travel and international tourism, given the extent of the cross-border transactions that are tied to that.